First off, let's go take a look at EQB stock. So I found this kind of interesting because if we take a look here, EQB reported its earnings and it is up. Actually, wait, sorry, let me go to a 1 month view. Yeah, so it is up about 5% after it reported earnings. The stock has actually been doing quite well recently too. It's quite a bit off its lows. Pretty volatile stock with the overall banking sector. It dropped like 20% from its high here in February, but now it is actually outperforming from the lows, up about 15% from the lows. So I think the market is finally realizing like Equitable Bank is actually not exposed to the US banking crisis that's currently going on. They said very clearly in their conference call this quarter that they're totally insulated. Like it is total irrationality for this stock to be selling lower with what's going on in the US right now because Canada is just has very different fundamentals. So let's go through some of the key things I found for this quarter. Right away, their total deposits are up 12% year over year to 8.1 billion. Their customers are now at 336,000. That is up 26% year over year. And on the conference call, they said that they're now approaching 350,000 customers 1 month into the next quarter. So their customers on the quarter have already increased by another about 14,000, which is, I actually don't know what that math works out to be. I think that's about 5%. 5% growth in another month, just 1 month. They launched their EQ Bank card in the Q1, and so far they have 40,000 customers with that card. So yeah, overall you can see deposits are going up. They still expect their deposit growth of 20 to 30% this year for a bank that is very, very strong.
I like their hot pink color scheme going on there.
Yeah, it's nice. So this was some of the highlights that I found from their quarterly results. So they reaffirmed their previous guidance for 2023. We'll take a look at that in a second. Adjusted Q1 a return of equity of 16.9%, which is above their 15% guidance. Adjusted Q1 net income was over $100 million. So this was the first quarter ever where they finally crossed $100 million in quarterly earnings. It's up 10% year over year and quarter over quarter. So earnings are at an all-time high. The bank is continuing to grow very strong. Common share dividend, 37 cents per share now, up 28% year over year, 6% quarter over quarter. Just so everyone knows, this bank is projected to increase its dividend by 6% every single quarter over the next 5 years. That's what management has told shareholders. So
6% quarter over quarter?
6% quarter over quarter for the next 5 years.
What? Oh my gosh, that's a lot.
It's a lot, dude.
I'm trying to do that math in my head of how many times that is, because it's 6% times 20 times compounded.
Yeah, so when I was buying a lot of the stock in the $45 range, the 5-year projected dividend yield on cost will be somewhere between 8 to 10%. If they continue this up and they have with the earnings at all-time highs, with earnings growing 10% year over year, I don't know. I think they're going to hit their guidance. They have a history of meeting and exceeding their guidance, so it's very good.
So I'm not sure if we should trust this Google search here, but I'm seeing that if you had $1,000 investment at a 6% and a compounded 20 times, that then you would have just over 3.2 thousand. So that means that they're going to increase their dividend 6% quarterly for the next 5 years. That is going to over 3x the dividend from what it is today. That is, sorry, last clarification. This is dividend per share increase. I mean, hey, I'm not investing in banks. You guys know my brand there, but just on paper, that sounds like some good cash for shareholders right there.
Yeah, I'll talk about that more in a little bit, and I'll explain to you how they're going to do that. But EQ Bank recognized as the best bank in Canada for the 3rd consecutive year by Forbes. So yeah, very nice recognition there. Again, customer growth of 26% year over year to 336,000. Right here, so they started reporting more liquid ratios and more information essentially on their quarterly earnings due to what's going on in the US banking sector right now, because they want to make it crystal clear that they are totally insulated from what's happening. So nearly 95% of the bank's deposits are either term or insured. And this is super interesting because Equitable Bank, what they've been doing for years is limiting customer deposits to 200,000. So they actually don't allow the vast majority of their customers to deposit more than $200,000. Why is that? Well, it means that basically all of their deposits then are insured by the government. They don't actually have any liquidity risk at all because they limit people.
How can they service customers who have more though? Because you don't want to leave that potential revenue on the table for the bank.
I think they sacrifice that potential for absolute assurance of their bank. And
Wow.
they've been doing this for years.
Yeah, I mean, tying this to First Republic and Silicon Valley Bank, we all know the fate of what happened to those. They had a lot of wealthy depositors, whether that was startups that had tons of money or even for First Republic, just quote a bunch of rich people in there. So, yeah, very interesting strategy. I mean, it seems like it's working for them though in terms of their numbers, right? They're going up.
Yeah,
People trust them.
and they said the average person has about $20,000 in deposits. So, I mean, yeah, they're probably missing out on some deposits from high net worth individuals, but on average, it's not really affecting them too much. Anyways, moving on, their total capital ratio is 15.5%. CET1 ratio is at 14%. This is very high. And this is why I like Canadian banks, because the Canadian regulators, I believe, have a minimum CET1 ratio for banks of somewhere around 12%. If you go and take a look at the US, I think the minimum is something like 6 or 7%, which is just very low. So this is like essentially how much liquidity there is. EQ Bank, 14%, in my opinion, is very high. Book value per share is at $64 now. It's actually above where the stock is currently trading. It's up 12% year over year, 3% quarter over quarter. So this bank is growing super well. Like, yeah, it's doing pretty well. Another thing they reported. So everyone is worried about office real estate right now. Everyone's like, these banks are going to have massive losses on office real estate. Well, Equitable Bank addressed that. They have $51.8 billion of total bank assets. Office lending is less than 1%. So even if all of their office portfolio went to zero, the bank would still be fine. They do not lend to office real estate. They thought that was a risk. They saw that coming, and they said in their transcript that, you know, we're insulated from this event as well. So that was good. Key one metrics versus guidance. Return on equity above guidance, pre-provision tax income growth, 8.7% quarter over quarter. For the full year, they're expecting 25 to 35% growth. Diluted EPS growth for the year is going to be 10-15%. They're already on track to beat that. Dividend growth, they're on track to hit the 20-25% growth. They're on track for book value per share growth, and their CET1 ratio is already above guidance. So they're on track. They're doing great. I think this bank is now selling for a price to earnings ratio with their adjusted numbers from their acquisition of around 6. So yeah, that still looks quite cheap to me, and I'm happy to own it. It's just a very consistent stock that's compounding away.